All right. I think it's time to begin, and our friends will all join in as they come in. So, good evening once again, everybody. Welcome to the MSME Knowledge Series webinar. I'm Shalini Dabholkar, the COO of India SME Accelerator Network, and I take this opportunity to welcome all of you. Today, we have 30 plus participants who are trying to join us, and we welcome all of them to join as and when they can. We have a very interesting and totally relevant topic for today, which is the domestic and cross-border supply chain financing. At a time when COVID-19 pandemic has really left most businesses concerned over not just cash flows, but also about is extremely relevant for us to understand what more apart from just emergency credit line, etc. So in the last webinar in financing business recovery, we covered that a lot. We covered about how government has come up with schemes to help MSMEs and how the banks are rolling those out. But what we're going to do today cover is beyond that. We're going to understand and look at more sustainable options that are available for the MSME trade, not just locally, but also internationally, when you do cross-border transactions. So this is an extremely exciting topic, very close to my heart as well personally. And I don't want to, buy out too much of the time for today. So given that, I'd like to, go ahead and introduce you to the speaker for today, who's come here and sparing her time to enlighten us on this topic. She's a banking professional with over 2 decades of experience in multiple roles across public sector, private sector, and multinational banks. She has expertise in transactional banking sales, trade finance, and supply chain. She's worked, especially over the last 11 years, with prominent large corporates as well as MSMEs. She's also had a brief stint as a CEO of Receivables Exchange of India. She is currently the Executive Director and Head Sales for Global Transaction Services at DBS India Limited. Over to you, Runa. We're very happy to have you.
Thank you, Shalini, and I'm very pleased to be here and amongst and part of the uh, wonderful initiative you're running for MSMEs. So very glad to be here, and I hope I'm able to add some value or leave some insights with the audience here today. Uh, I hope I'm audible, so I'll just start sharing my screen.
Definitely.
Yeah. Right. Great. Thanks, Shalini. And like Shalini said, I think the idea of the discussion today is really not to focus on the schemes or the COVID-19 related exemptions or extensions and moratoriums that MSMEs are getting. I think given times, of course, of all the segments in the country, MSMEs will need the maximum support, and the Reserve Bank, through banks and authorized dealers in India, will is bringing uh, a slew of initiatives and measures, and as we speak, I think they keep recalibrating what can be done in terms of the time window for repayments, in terms of the moratorium, the interest benefit, etc. But what I wanted to talk about and I wanted to leave with all of you is what is available, and sometimes the right audience does not get to hear what is already available within the system, be it through banks or other players, where MSMEs can benefit from getting financing which does not actually stretch their credit lines, which is at a better pricing than what they would get on standalone basis. And with this background, I would like to delve into the nuances of supply chain finance, how MSMEs can benefit from it, and what it really means from a transactional and operational process. All right. So I think just to set context, I think we are all, in business either as traders or service providers or manufacturers. But at the end of the day, you always have to be able to sell to someone for your business to grow, and therefore the buyer and seller sort of terms of trade becomes extremely important. Clearly, the terms of trade are derived from the supplier position in terms of, the strength of the supplier, the criticality of the raw material that is being supplied. If you are one of many suppliers, or if you're one of a few suppliers, is what you will determine, your ability to negotiate terms with with your customers, and depends on also the customer profile, I guess. So I think that's why it's relevant, and which is, it might be sounding very simplistic to you, but the fact is that if we really think about the commercial aspect of what we do when we sell, and we find that we are in a position of strength in terms of, by virtue of our product, or penetration, or by virtue of our something differentiated that we offer, then I think we should think through the terms of trade and see if you can get an advance from your customer, or if not an advance, then a credit period which they can potentially support if the need should come up. In the last few months, and I think now it's been over 100 days since we've all been grappling with the challenges that COVID-19 has brought, we as a bank, and when I speak of DBS Bank, and I'm sure there'll be others on the street, have seen that large corporates have look for solutions which are scalable, which are sustainable, by whereby they can support their supply chain, because for them the supply chain is as critical. And while there have been a few who've delayed payments to suppliers, and there are other issues around that, and I'll talk about it in a bit. But clearly, I mean, I think the supply chain has become, right and center of focus for, corporate India as we speak. So when we speak about, MSMEs and payment terms, essentially there is actually a regulation, and I don't know how many of you are familiar with MSMED Act, which was sort of updated in 2006, which clearly mentions that any payments to MSMEs cannot be delayed beyond 45 days of acceptance of the invoice. And in case you do see such delays where there is no fixed payment term, you are actually well within your rights to raise it to the anchor to say that this is in contravention of the MSME Act. I'm aware that there are people in the Ministry of MSME, in the chambers of MSME, who actually track this for their MSME customers. So really, while I understand that the best way to grow your business is not by actually getting into situations of conflict with your buyers, but clearly I think you should be conversant of and aware of the rights of an MSME when it comes to payments, so that you are able to at least articulate that you're aware of where you stand from a legal perspective. So, coming to the topic that we really want to speak about today, and which is regarding supply chain finance, I mean, this schematic actually, is a very simplistic sort of representation of the whole chain. But typically, it is really a solution where MSME can use the balance sheet strength of its buyers, provided they are, you know, buyers which have some commercial standing, could be multinationals, large local corporates, and who have better access to banking than the MSME. uh, Once the goods, I mean, the invoice and the transaction has been contracted and the invoice has been generated, and the MSME has supplied to the large corporate, and there is a credit term that is agreed between the bank. Once the large corporate accepts uh, the anchor can actually run the anchor. When I say anchor, I mean the large corporate can actually run a program whereby they negotiate probably a discount with the MSME, because the rate that would be offered to be the MSME by the financer, because the payment risk is on the large corporate, would be much better than what they would be able to get on their standalone balance sheet. And on the due date, it is so the SME gets paid upfront, net of discounting charges, and on the due date, the large corporate has payable to the bank. Why this works, and it's not that large corporates are only doing it to support the supply chain. Some would do it because there are certain industries where the supply chain is extremely critical, and it is actually a function of how competitive the customer can be if their supply chain is competitive. But the other aspect to it is that it allows the anchor corporate also to improve their working capital cycle, and they are able to actually increase their days payable outstanding, and therefore the stress on their working capital is reduced to a large extent. Suppliers will get access to liquidity, and they'll get paid early, and which will decrease their day sales outstanding and therefore their receivables period. Secondly, I think, like I said, in certain industries, the supplier relationships are very, very critical for the success of the business. And when anchors step in to support their supply chain, it definitely builds very strong channel loyalty, and which is good for both, the supplier and the anchor in terms of their respective businesses. As far as suppliers are concerned, like I said, they would get non-recourse financing at very competitive rates, because they actually leverage off the buyer's credit rating rather than their own standalone rating. It's a balance sheet neutral solution for the anchor. So the way most banks would structure this would be like an off balance sheet solution. So it will not be debt on the balance sheet of the anchor, and therefore they would be agnostic. And for them, it continues to appear as a trade payable. So if they are able to negotiate with the MSME to get a longer credit period, their working capital position improves and their balance sheet actually looks better than it is. Again, for the MSME, it is their trade receivables which get converted to cash, and therefore it also improves the quality of their balance sheet. And especially important because MSMEs are always trying to raise finance at better rates, and therefore, if their working capital position looks better by getting solutions like this where they can actually get better pricing as well as accelerate their collections, they are able to generate a much healthier balance sheet, and therefore it becomes a self-fulfilling sort of exercise that every time they do a transaction like this, they are able to improve the quality of their balance sheet and therefore able to get more ability to raise financing on a standalone basis. So it helps them from this aspect as well. And of course, a financially robust supply chain can lead to more certainty and reliability of supplies, especially in situations like this where there is a lot of disruption across segments, industries, logistics, all of that. So I think the supply chain certainty becomes very, very important. And for the supplier, it obviously enables payment certainty and cash flow forecasting. And because this is very transactional and linked to invoices, there is also significant transparency to the supplier. So let me spend some time talking about the kind of solutions banks and financial institutions have to offer. And some of this could get a little technical, so I would encourage you to ask any questions if you think this if this needs a little more explanation, and I'll be happy to do that at the end. So model one would be the most simple model that banks run, and it is a lot like I described earlier, where typically the anchor and the bank, and when I say the anchor, I mean the large corporate or buyer of the MSME, would work together to design a program where typically the invoices which are generated by the supplier are uploaded into an electronic system, and the buyer would accept those invoices for payment, and the bank would pay off the supplier net of discounting charges, and the buyer would pay the bank on the due date. So this is basically a post shipment, post acceptance kind of a model. Model 2 again, and I think model 1 is run a bit differently by different banks. So some banks would actually do a full KYC and onboard the supplier, Some banks may do a financial due diligence as well and make this with recourse to the supplier, even though ultimately, they know that the payment risk is on the buyer. But just to be additionally cautious or comfortable, the bank may also have recourse to the supplier. So a lot of private sector Indian banks run it in this model. The other model is the sale of receivables, and this is from a supplier's perspective. So, a lot of banks, what they will do is while they will work with the anchor to set up the program, in terms of KYC and onboarding, what they will do is they will get the basic KYC details of the supplier. And instead of actually doing a financial due diligence, they will sign what is called a receivable purchase agreement with the supplier, which is actually covered under the Factoring Act. So, in a sense, what the supplier is doing is selling his receivables to the bank, and the bank steps into the shoes of the supplier to collect that receivable on due date. So, it is off balance sheet for the supplier because a sale of receivable is not constituted as debt. It basically on your balance sheet, your receivables will get converted to cash. In terms of the buyer, what it would mean is that they have extended the payment term and they will continue to show a trade payable. And on the books of the bank, you will, be a KYC customer who has sold his receivables to the bank. So that's how Model 2 works. Model 3 is a payment service model, and which is what we at DBS run. And this is an extremely scalable program where we work with the anchor corporates as a paying agent. So the buyer actually appoints the bank as a paying agent, and then they give us confirmation letters that XYZ are their suppliers for whatever number of years, and they would like us to pay them early at the request of the supplier. And all that the supplier needs to do in this sort of a program is to give us an early payment request. And there is actually no full-fledged KYC involved. The onboarding is completely digital based on maybe a corporate PAN number and a couple of other credentials, which we kind of check digitally. So we've scaled up programs during the end of March, which was a very, very disruptive time. And we scaled up programs and we've added, 200, 300 suppliers to a particular program. And one of them happens to be a large retail chain, which is a domestic large retail chain. And we had that program up and running within a couple of weeks. And we added about 200 suppliers into that program. And that has essentially happened because of the model in which we actually don't do a full-fledged KYC of the customer and don't get into too much of paperwork. And this again, I mean, on both sides, from the supplier's side, they have only, taken an early payment based on a discount rate that they paid to the bank. From a buyer's perspective, it is again a trade payable, which they will pay to the bank because the bank has on their behalf early paid their suppliers. Now, we've added another element to this recently, which is also allowing for financing at the pre shipment stage, where the buyer can accept the purchase order, which can confirm the purchase order, which they place on the supplier, and can recommend that they be financed. This, of course, the pre shipment stage is with recourse to the supplier because the bank has to, as per RBI norms, onboard the supplier and do a full KYC and do a little bit of financial due diligence and credit assessment for the pre-shipment leg. But given that this is part of an integrated supply chain program, the buyer would normally be able to negotiate a much better rate for the supplier than the supplier would be able to do on a standalone basis. Now, moving out from banks, and I think this space has really been evolving in the last few years. So, you do have a number of fintech players who are in the space of supply chain financing. In fact, a lot of them are considering getting into the space. So, this is a space which is not just evolving in India, but it's evolving globally. And there are names like Credex, there are names like Indifi Technologies, there are other names like Priority Vendor, Credible, C2FO. So I think there are different models in which they run it. One is they will typically do an escrow with the buyer and the seller and arrange the financing through a financer who could be a could be anybody on their platform. It could be a high net worth individual, it could be a financial institution, it could be a bank. So the financiers will obviously agree to lend to a certain supplier, buyer pair based on their assessment of risk. So typically what happens on these platforms is, maybe because they are not banks, they are able to finance risk which is probably lower than the rating that banks would finance. But said which, then obviously because the financiers could be individuals themselves, there will be an expectation of a rate of return for the higher risk that is being taken. And therefore, while the ability to the volume or the value of financing could actually be larger, the pricing also would be probably a little less competitive than what you would get through a bank program. Beyond this, and I think some of you would be aware, or at least I'm hoping you would be aware, is that RBI in 2015 approved licenses for three players and who could function as trade receivable electronic discounting system, that is TRADES entities. And these are there are currently only three players in India, which is the Receivables Exchange of India, which is a joint venture between SIDBI, NSE, and a host of banks, including ICICI, Yes Bank, and SBI. A-Trades, which is promoted by Axis Bank, and M1 Exchange, which is independently managed by a company called Mind Solutions. Now, the whole framework for trades was set up by RBI to ensure that MSMEs are able to access transparently financing for their receivables and at a rate which is competitive. So, over and above the invoice financing methodology which I described for banks, what Treds does is, buyers actually, the Treds platform integrates the buyer, supplier, and a number of financiers. So, the financiers could be banks or NBFIs or factoring companies on this platform, and all of them would bid. So if you were a supplier who raised an invoice on, say, Reliance Industries, and Reliance Industries is a participant on trades, you could actually upload those invoices, and the 5, 6, 7, 8, 9, 10 financiers who are interested in that invoice will be bidding. And therefore, because of the process of bidding or auction, the price discovery is very, very high. So we've seen suppliers who supply to large customers getting rates much below 7% as well in today's day and age. So I think this is something that unfortunately has taken some time to scale up. The potential is very large. I think the other advantage in trades is you don't actually need to physically submit paper. They have done a tie-up with GSTN where they can work on the e-way bill update, or it can be an upload of documents, and the entire transaction happens on scanned documents. The process, I think, because TREDS is an anchor-led program, and there are so many banks in that field, I think TREDS has been over the years gradually adding anchors. But I think in terms of scope and potential, it would be very, very large if the SME awareness is there. That such a facility is available, and public sector units are mandatorily supposed to be in TREDS. So if any of you supply to a PSU, you can actually upload your invoices on a TREDS platform. You can get registered with a TREDS platform, upload your invoices, and get financed at very, very competitive rates. The other, initiative that the government had started a few years back is called the Government E-Marketplace. Now, this is not necessarily a financing initiative, but it allows micro and small and medium players to actually go online on an e-commerce sort of platform created by the government for purchases by the government, public sector, and government departments. So anything that the government procures has to be done through the government e-marketplace, and it is mandatory for them, for the buyers here, which would typically be PSUs or departments of government, to make available financing or to pay off the vendors within 15 days. And there are banks also integrated who can actually finance the MSMEs who bid on the government marketplace. So again, it has a lot of advantages. So if you do supply to the government or the public sector units, then I would encourage you to actually have a look at what the government marketplace has to offer. And we've seen like people, very very small handicraft players. An old lady in a northeastern state of the country is actually a supplier on government marketplace. And while these cases are few and far between, the platform does allow for people to come and transparently sell to the government. Finally, I'll move to what is called receivable financing or factoring. Now, typically, factoring is just the reverse of what we spoke on the supply chain finance side. Supply chain finance will typically be anchor led or anchor driven. Factoring is something you as seller of the receivable can initiate. So potentially, if you're selling, say, to a pharma company like Cipla, and you could be a packaging manufacturer who has receivables from Cipla, which Cipla pays every 60 days or 90 days or 180 days. Technically, in your case, it should be paid in every 45 days. But anyway, so whatever are your commercial terms with the company, you could potentially go to a bank and choose to sell your receivables, for which you will typically sign what is called a master receivable purchase agreement. And that kind of is the bank buying the risk of bankruptcy and insolvency. So, if on due date Cipla were not to pay you for reasons not linked to performance, so if you don't perform, of course the risk comes back to you. But if you have performed and there are no reasons of rejection of goods, but only issue of delay, intent, bankruptcy, insolvency, the factoring company or the bank who has underwritten the risk of the obligor is cannot actually come back and ask you for the money if the company has challenges or is delaying. They will proceed under the factoring act and the charge that they register in CERSAI to proceed against the obligor. So this is a tool that's available, but of course, factoring companies or banks would then do a full analysis of the credit of your anchor client. And depending on what kind of credit profile it is, they would come back to you in terms of pricing and availability of limits. So this is on the domestic scenario, but factoring works very well on the export scenario as well. So again, factoring both domestic and exports are both off balance sheet for the seller of the receivable. uh, of course, the off balance sheet treatment has to be vetted by your internal auditors. But there are some banks, for SMEs, they may actually look at doing this only with recourse, unless the credit counterparty is a very, very strong counterparty. So I think that's the reality of it. But said which, there are, especially on the export side, there are banks who provide credit cover, who provide collection services, and the models can be with or without recourse. So if it's with recourse, you still get the benefit of getting a better pricing because it is on account of the receivables of a larger corporate. If it's without recourse, possibly there'll be a higher premium charge because of the insurance sort of underwriting risk that the financer is assuming. But banks are tied up with a lot of export factors externally to be able to finance the export factoring piece. In India till now, actually IRDA has prohibited banks from factoring receivables with insurance cover. So banks can only factor receivables where they have very strong credit comfort on the credit standing of the buyer. But offshore, you can actually do factoring against insurance. So if a buyer or a financer goes and buys insurance against insurance on a certain name, they can actually factor those receivables against insurance. IRDA is working to change that for domestic factoring companies and for banks, and that is something that is expected in a few months in India as well. So that's really all I had in terms of the access to supply chain finance and to receivable finance. But clearly, I think the solutions which I spoke about are available both domestically as well as on the cross-border side. On the cross-border side, a lot of you may be sort of supplying against LCs or I mean typically uh, depending on the client profile that you supply to, LCs can be confirmed and discounted, and which is as good as off balance sheet. LCs can be forfeited. You do have lines of credit which Exim Bank offers to countries which are tougher country risk. So there are a host of measures beyond factoring and receivable finance which can be used to mitigate your risk of you know export sales. So with that, I come to the end of my discussions. Any questions? I'd be happy to take it.
Great. Thank you so much, Runa. That was absolutely enlightening in terms of what all banks can do. I think it's been an eye opener for several participants right now to know that beyond the word loans that we hear with banks, there is so much more that banks can do based on the kind of transactions you're doing, based on the kind of customer profile you have, based on the volume of transactions, whom you are dealing with in your value chain, in your supply chain. So I think that's been extremely useful. We have questions coming up. I'll begin one by one with them. First question here with us is for payment in PSU, which works on contract. What do we do? What's the best way to go about it?
So for payment from PSUs, I think I would encourage you to explore the TREDS option. So you can choose any TREDS provider, whether it's an RXIL or M1 or A-TREDS. The PSU should be typically a registered buyer. So I know for sure that all the oil companies are on these platforms, and I think the number of PSUs, and it's mandatory for any PSU and any company in India, which is so MCA has a notification that any company in India which has a turnover of 500 crores and above needs to be on any one of the TREDS platforms. So it would be important for you to check that this PSU is listed on the TREDS platform, and when you upload your invoices, typically they are bound to accept and pay. Now I know the issue with PSUs is a little different. They take very very long to actually accept the invoice, and then they pay within 7 to 10 days. uh, but having said that, I think that is getting attention from the government, and I think there has been more and more discussion in terms of telling PSUs to accept invoices earlier, because even the MSMED Act starts to kick in from post acceptance. So I think what's important is to be able to get them to accept early so that you get the credit period for which you can avail the financing.
Okay, great. That was absolutely helpful, I guess. So, Paresh, I'm sure you've got your answer. The next question coming to us is the supply chain financing same for e-commerce marketplace as well, or are there any different regulations for customers?
So e-commerce marketplace typically, I mean, you would be, say, suppose you're supplying to, say, a cloud tail, you would not normally supply to an Amazon. Now there are banks who are running programs for cloud tail. There are banks who are running programs for Perio retail. So these are the companies who are financing, who are actually the invoicing arms for these companies. So, but if you're asking if you are listing goods on an e-commerce platform, and is there financing for the period till which time the buyers and have not settled with Amazon, or the money is not out of the nodal account? I think that is more kind of financing on the seller profile and looking at the business that you do on the e-commerce platform. So there are a number of Indian sector banks who are working with, at least the larger e-commerce players, to be able to offer financing. And typically that financing is of much shorter duration. It's about a couple of weeks to match the payment cycle of the e-commerce platform. But if you're actually supplying to any of the e-commerce owned logistics companies or the warehouses, then there would be very similar programs to what I mentioned, where 30, 60, 90 days of credit would be there, and there would be banks willing to finance that risk.
Okay. I hope, Sankalp, you've got your answer to that. We have a similar question coming, which is on trading. So, any specific advice for somebody who's looking to get into goods and commodities trading, especially during these times?
Right. So I think traders, while I think there is a updated sort of definition for MSMEs, and they would also classify to some extent. Uh, I think traders, again, it really depends on who is your counterparty. That is key. What are the kind of payment terms you have? If you have a credit period and if you have an acceptance from your counterparty, then you can definitely sort of take these solutions. uh, I mean, typically what does happen is that, especially when banks come in, and there are of course financing companies who would be happy to look at it. Banks would probably look at the trader community in the sense that they would not really know about the underlying flow of goods and the whole supply chain cycle for them. So I think as long as that is clear and available to assess, I think these kind of solutions would should be available to traders as well.
Great. Rajesh, does that answer for you? I hope you got that. The next question coming up is, what is better? Working capital loan is better or receivable financing is better?
So it depends on what your objective is. I think receivable financing is better because typically you will get the benefit of the. I mean, typically you will be able to do a receivable financing only if the credit rating of your counterparty client is better than yours, and in which case you will probably get a benefit in terms of the way it is priced. But also over and above that, it will be off balance sheet. So typically, I think for MSMEs the problem is of receivables which are delayed or stuck. So once you convert your receivables to cash, your balance sheet position itself will improve, and therefore your ability to even raise on balance sheet loans will become better in terms of the profile that you have today vis-a-vis what you want to achieve. So I think there are banks who may insist on collateral. When you do working capital loan, they will typically insist on collateral. A receivable can be carved out from that whole stream, and therefore it's not like a floating charge on your collateral, but a specific stream of receivables. So it really depends on what your objective is and how you want to plan your sort of what you want to achieve from your balance sheet perspective.
Great. Thank you for that. The next question is, I do not know my customer's profile. So for receivable financing, should I approach my customer or the bank?
So I mean, just to understand a little bit better, which means you're probably not a repeat supplier for the customer. In which case, potentially, I mean, yes, if these are large customers, you can even be like, for instance, we are running a supply chain program for an agri commodity company where the suppliers keep changing. So in our model, it's easy for us to keep switching on and off suppliers. But typically, a bank who's doing it with a KYC led model may find it difficult to keep adding and removing suppliers. So in that sense, I mean. Yes, if you don't know your customer's standing, then I think it's important to ask your customer if they provide any support to in the form of supply chain finance. And if they do, what kind of credit periods would they be looking at, and what kind of pricing would that work out for you?
Okay. Thank you very much. I hope it answered for the participant. What happens if the customer defaults or closes down?
So if it's a sale of receivables, clearly it is a risk that the factor is underwriting. Now, the factoring factor could be a bank, it could be a factoring company, but whoever has factored those receivables is underwriting that risk. And typically, the standing of a factoring company or a factor is defined in IBC as the standing of the creditor. So instead, you would have been paid upfront by the factor, and because of insolvency or whatever liquidation of the company, the factor will step into your shoes as a creditor to recover the loan, recover the amount that is due on due date. So it is actually it and actually any overdue receivable financing gets reported under SMA for the anchor. So typically people don't want to default because it's as good as a loan default.
Great. That's quite a comfort for a supplier to
That's
understand.
right.
Yeah. How should I arrive at how much to ask in working capital financing?
So that's very simple actually. So working capital has three vectors. One is your sales, the other is your payables, and the third is your inventory. So typically it is your DSO plus so you have a day sales outstanding, you have a day inventory per days, and you have payable days. So typically, I mean, if I have to look at the formula to it, your sales on the basis days, which is 365, and I mean against the amount that you have outstanding in your receivables, that would bring you to your DSO. So if you calculate your DSO, DIO, and DPO, your working capital gap is really your DSO plus DIO minus DPO. So your receivable days plus inventory days minus your payable days is your working capital gap. So for instance, if you sort of receive in 180 days, your inventory days are 30 days, so 210, and you pay within 30 days, so then you need working capital of 180 days.
Wonderful. That was very simple to understand. Next question is, what kind of pre-shipment finance is available for trader to procure goods from manufacturer?
So again, I mean, pre-shipment finance on standalone basis is of course available in the form of working capital loans, etc. But if it is linked to a larger supply chain program where your corporate is a large corporate, so for instance, you have a Unilever, for example, who has certain SMEs who have been suppliers to them, and who may want to support these SMEs from a pre-shipment perspective. Uh, they can actually confirm the PO, but the bank would still have to do a full diligence. So, in that sense, it is similar to a WCDL, but I think the bank may treat it as a better risk and therefore price it better if it is linked to pre-shipment financing. So the options to get pre-shipment finance will typically be your WCDL or working capital finance.
Great. Does that answer the question for you, Sumo Healthcare? I hope that does. The next question is, will a low credit rating affect my financing?
Yes, it will. And which is why, I mean, typically say if you have a low credit rating but you're selling to better rated companies, especially among the larger segments, say suppose you're selling to you know like a Godrej Consumer, for instance, or Godrej Industries, then typically you can get added to their supply chain finance program and benefit from it. But yes, if somebody is actually giving you standalone financing, your track record will go into the risk assessment. But that's really a bank view with as many fintechs as we have today, and financing moving out only from banks to other players in the market. There will be who there will be people who will be willing to underwrite that risk, and there are a lot of fintechs who are doing this, but of course the price, it comes at a price.
Okay, Great. The next question is here. Would you be able to tell us a little more about bidding in trades you
Yeah.
mentioned?
So let me take a live example. Assuming you are a supplier who's registered in trades, you have a buyer, say Indian Oil Corporation, which is registered on trades, and you have an invoice that's of say 45 days, and IOC has accepted that invoice. So when you actually upload that invoice and IOC accepts the invoice, this invoice goes into bidding. Now there may be 8, 10, 12, 30, 20 financiers on the platform. Out of that, whichever financer is interested in bidding, they will actually leave a rate on the platform at which they will bid. That bidding window will be open for say 24 hours, 6 hours, 8 hours, depending on whatever is agreed and set up. And till that bidding window, till the time you get the lowest rate, uh, you can keep receiving bids. And then finally you can actually select the lowest rate and get your invoice financed at that.
Wonderful. I think this sounds like a dream for suppliers to get bidded on financing rather than having to run door to door,
Yeah.
seeking.
So I think threads is a great concept. Only thing is, the number of anchors who've gotten onto threads, I think has only increased in the last few years, but it's not, all encompassing. And the threads exchanges themselves in terms of being able to sort of onboard suppliers, etc. They've been working through challenges of doing the KYC, etc., because that's what RBI mandates them to do. But once it's all done and the supplier and the buyer are on trades, I think it is extremely competitive. I mean, we've seen suppliers, and when I was at RXIL, we've seen suppliers getting funded at 7% or below 7% rates, only on account of the bidding.
Excellent. I think that's given a very good roundup on the various options that MSMEs can look up to with regards to banks, with regards to fintech that you explained, with regards to the government e-marketplace and threads and so on. So if there are any more questions, please drop them into your chat box. And while they do that, Runa, I would like to request if there's any other guidance you'd like to leave behind for MSMEs, in the current situation of kind of getting out of COVID, something that they could bear in mind.
Sure. So I know, I mean, I fully sort of understand and appreciate that it's an extremely difficult and challenging time, more so for MSMEs than, most other sectors. But clearly, I think with everything that the government is doing in terms of, the moratoriums and the support, etc., I think it's really a time to be able to, take stock of your business and see how competitive you are, uh, reduce your cost of financing. And if there are solutions like this that you can use without actually leveraging yourself further, I think look at those. And there are plenty of solutions today available in the market, which are, of course, there is bank and NBFI led, but there's also a lot of technology solutions. So I think one thing that I did not touch upon is that there are a lot of companies which are cash rich, like so example Asian Paints. It's a cash rich company. They run their own program through a fintech where they would support their supplier, and the suppliers would probably say that I'm willing to take financing as at X rate, and the anchor himself would be making that financing available to them. So if you have customers who are cash rich, who are using these kind of fintechs, please do discuss with them the ability to get financed on a platform like this.
Right. Wonderful. Thank you very much for that piece of advice, Runa. This is really helpful. Today's session has definitely been different from many other sessions we've had in the past, especially after the last session on financing business recovery, which focused more on the government scheme. I think today people have got to understand about various other options that they can really go out and look at and select the one that's most suitable for them. The way you've enlightened it and simplified a lot of this for people. Currently, many MSMEs that we know are sitting with a cash crunch at the receivable front.
Yes.
And that's just passing down the pipeline from from the larger corporates itself, coming down the line to the smallest guy in the value chain. And if we could leverage the credit worthiness either of our own organization as an MSME or the customer, whoever is stronger, bigger and better, look at the product that would be suitable for your kind of transaction. And with that way, a single unlock of the cash flow, a single transaction that you do, could turn out to be significantly valuable for your business to get that impetus you're looking for. Sometimes it's just that one push that you need as a business to take it into the next level. So I would really urge the MSMEs to go back, look at their balance sheets, look at their payables, receivables, look at the profiles of the customers that they're dealing with, and really work this through. We're always there to help and guide, as a platform. And we have eminent speakers like Runa, who has been very kind to come and spare her time today. So we're all there to collectively help. And therefore, thank you very much, Runa. This is extremely valuable for all the participants, and not just the ones who are here with us today. The session will go live on YouTube and will be available for all our members to be, getting to know more subsequently.
Thank
So,
you, Shalini. It's been a pleasure, and I mean, I really wish every participant and all your members, all the very best in these difficult times, and and stay safe. And I think on both business and personally. So thank you so much. It's really been a pleasure.
right. Thank you very much, Runa. And thank you very much, all the participants. That's it from us for today. Bye bye.
Bye bye.
Say that at the ground level, where there is retail banking